Okay, let's jump right into it. Welcome to this explainer. Today, we're cutting through the noise to deconstruct a really fascinating anonymous expert report on the most dangerous tax traps that are quietly eroding your wealth. We're going to act as a specialized analytical engine here, no surface level filler. If you want to understand the actual cause and effect mechanisms hidden in the tax code and learn how to preserve your wealth at an expert level, well, you're in the exact right place. We'll be using a fallacy to framework model today. We've got 6 core areas to hit: the compliance versus strategy divide, entity structure misconceptions, real estate errors, deduction overreach, income concealment dangers, and we'll wrap up with structuring for wealth preservation. Let's get going. All right, section 1, the compliance strategy divide. Let's look at a fundamental misalignment in how high earners handle their financial obligations. So we absolutely have to draw a hard line between tax compliance and tax strategy. Think about it. Compliance, that just reports what already happened. It's totally historical, reactive, and usually relies on basic DIY software built for simplicity, not for protecting a complex, growing income. Strategy, on the other hand, is forward-looking. It's proactive optimization. If your income is scaling up, but you're still treating taxes as this once-a-year historical chore, you are, mathematically speaking, guaranteed to lose money. Seriously, guaranteed. There's this great quote from the expert report that hits the nail on the head. It says, "Good tax advice is a powerful wealth-building multiplier, but bad tax advice is a wealth destroyer." And it's so true. The tax code, it doesn't reward passive compliance. No, it specifically rewards active, intentional alignment with its incentives. If you rely on basic reporting when you've got complex business or investment income, you're literally leaving massive amounts of your capital exposed to default overtaxation. Moving right along to section 2, entity structure misconceptions. Let's unpack the massive difference between legal protection and tax efficiency. Okay, here's a huge fallacy. Believing an LLC just automatically saves you tax money? Actually, scratch that. It's mostly just a legal shield. By default, the IRS taxes an LLC exactly like a sole proprietorship. The report highlights something pretty alarming. 92.35% of your net profit is exposed to heavy self-employment taxes. And that's before federal and state income taxes even enter the picture. Compare that to the S-corporation, which isn't just an entity. It's a specific tax selection that totally rewires how your revenue gets categorized. Now, this is where the S-corp election really becomes a game changer. As you can see, it forces you to split your profit right down the middle. Well, conceptually at least. One slice is your reasonable salary, which gets hit with standard payroll taxes. But the other slice? That becomes distributions. And the brilliant strategic mechanism here is that distributions legally bypass those heavy payroll taxes. It's an intentional division of capital that completely transforms your overall tax liability. But, and this is a big but, the explicit trap here is getting greedy and breaking the system. You can't just pay yourself zero or some artificially low salary just to maximize those tax-free distributions. The revenue service demands a reasonable salary that actually matches industry standards for whatever you do. If you skip payroll entirely or try to game it with an unrealistically low wage, you instantly trigger audits. The cause and effect is brutal. An audit reclassifies those distributions back into wages, and bam, you're hit with massive back taxes, severe penalties, and compounding interest. All right, section 3, real estate application errors. Let's examine the strict physical and temporal rules that trip people up. So a major drop here is this assumption that buying massive acreage automatically equals massive depreciation write-offs. Well, the analytical reality is that land is strictly non-depreciable, period. The system only lets you write off physical improvements and the building structures themselves. So if you go out and buy a land-heavy property thinking it's a tax play, you are actually diluting your depreciation ratio. Real strategy means prioritizing properties with a high building-to-land value ratio. That's how you maximize the write-off. Then there's the real estate professional status. It's a remarkably powerful tool to offset your active income, but it is purely quantitative. You literally need 750 hours of material participation, and more than 50% of your total working time has to be spent in real estate. Relying on rough estimates or, just verbal intent, huge trap. You absolutely must maintain rigid, contemporaneous proof of those hours, because without solid logs, the entire deduction collapses the second it faces scrutiny. Which brings us to a really important question. Are your assumed business deductions actually audit triggers in disguise? Because, as we'll see, taxpayers routinely cross this invisible line from aggressive planning straight into illegal overreach, just by misunderstanding the definitions. Let's dive into Section 4, Deduction, Overreach, and Risk. Let's look at exactly how people dangerously stretch these rules. People love to stretch the definition of an ordinary and necessary expense, but the reality is incredibly strict. You can't just write off a luxury car because you happen to own a business. You have to prove its actual business purpose with rigorous mileage logs. Same with the home office. It can't just be a desk sitting in a guest bedroom. The code demands 100% exclusive and regular use of that space. And those client golf outings or expensive sports tickets, those entertainment deductions were broadly eliminated under the 2017 tax laws. Stretching these definitions doesn't cleverly save you money, it paints a giant target directly on your return. Next up, Section 5, Income Concealment Dangers. Let's talk about the inescapable reality of modern digital tracking. There's this lingering assumption that side hustle money or cash income just sort of flies under the radar. In the modern era, that is entirely false. The Revenue Service does not care if you call it your main job or your side hustle. Income is income. Plus, 1099 forms and all these payment platforms, they create an automatic, bulletproof digital trail. Trying to hide this income is mathematically the worst choice you can make. Why? Because the penalties and interests you trigger usually end up exceeding the original tax you owed in the first place. Oh, and doing business in cash, that offers absolutely zero legal protection from reporting requirements. None. So let's step back and look at the entire board for a second. If reactive compliance software is failing you, and default entity structures are just bleeding your profits dry, and sloppy documentation is constantly risking audits, how do you actually fix the underlying dynamics? It really comes down to asking yourself, is your legal structure actually a tax strategy? Which brings us to our final part, Section 6, Structuring for Wealth Preservation. Let's map out an active framework to get this right. To navigate all this complexity safely, you have to mentally shift from being a reactive taxpayer to becoming an active partner with the tax code. Step 1, abandon those purely historical compliance habits. Start looking forward. Step 2, perfectly match your legal entities to your specific revenue scale. If you're highly profitable, sitting in a default LLC simply won't cut it anymore. Step 3 is all about discipline. Maintain unassailable documentation for every single hour and asset you claim. And finally, coordinate your investments, like real estate, directly with forward-looking tax incentives. You want to leverage intentional policy choices rather than blindly falling into default traps. And that leaves us with one final provocative thought based on this expert analysis. Are you going to let default compliance just quietly erode your wealth? Or are you going to take control of your financial framework today? Seriously, are you playing the game without truly knowing the rules, or are you ready to structure your wealth for the long term? The incentives are absolutely there, but the execution, that's entirely up to you. Thanks for joining me on this explainer, and keep questioning the mechanics behind your money.